Welcome to session 4 of Unit 1. Having dealt with the role of principles of taxation in the previous session, we continue our lesson by looking at direct and indirect taxation. In this session, we are going to look at the meaning of direct tax and indirect tax, the advantages and disadvantages of each. By the end of this section, you should be able to differentiate between direct tax and indirect tax. Give examples of direct tax and indirect tax. Explain the merits and demerits of direct tax and indirect tax. We start with direct taxes. Taxation, as pointed out earlier, is any sum of money which the government of a country compulsorily collects from her residents without rendering any service, giving any goods in direct return for the amount collected. And this can be directly or indirectly. So this gives us two broad classes of taxes. We have the direct taxes and indirect taxes. So we start with direct taxes. So direct taxes are taxes imposed directly on income or wealth of taxpayers. They are paid directly to the government as a result of income earned or wealth owned. They are levied on persons and company and is borne by the person earning the income. Direct taxes are collected by Internal Revenue Service. So we have some examples of direct taxes. We start with the payee tax. The payee is abbreviated, so the full name is pay as you earn. So it is a tax collected from employees' income and is paid by the employer on behalf of the employee. So in simple terms, it is tax imposed on the income of employees or workers, and it is often referred to as the payee system. This type of tax is mostly progressive in nature, and it is charged on all income of an individual in employment, whether it is received in cash or in kind. At the end of every month, the employer is supposed to file a monthly payee return on behalf of the employee and submit it on or before the 15th month on the month following the month in which the deduction was made. Two, we have company tax. So this is tax charged on a company's total income sources at the end of the operating year. Before we compute tax on companies' income, they are allowed to deduct certain expenditure as tax-free allowances. Then tax is paid on the net profit remaining. The tax applicable to a company depends on the industry, but the general corporate tax rate in Ghana is 25%. So we'll look at this more into details in Unit 4, Section 6. The third one is capital gains tax. So this is tax on profit on gains realized on the sale or disposal of an asset other than a trading inventory. So for individuals, you can either treat the gain isolated and be taxed at 15%, or you can add it to your other income and be taxed accordingly. For business also, the capital gains are included in their business annual return and taxed accordingly. So let us look at a quick example. However, capital gains tax is treated extensively in Unit 5 of this model. So assuming you have an asset worth 20,000 and you sold it for 30,000, the gain becomes 10,000, which is the difference between the sales amount and then the cost. So the taxation on this gain will be on the 10,000, and using the 15%, we are going to get 1,500 as our capital gain tax. The next direct tax is gift tax. This is tax on the receipt of something without consideration or for inadequate consideration, or even something given willingly to someone without payment. And then we can find this in section 4 and section 5 of the Act 2015, Act 896. Remember, I told you that we are going to make extensive reference to the Income Tax Act. Okay, here too, the percentage is 15%, and it follows the same rules as the capital gains tax. Either you opt to isolate the gifts and tax it at 15%, or you add it to other incomes and be taxed accordingly. Then we have the rent tax. First of all, let us look at rent income. Rent income is one which accrues to someone as a result of letting or leasing a property to another person. So the tax paid on the rent income is what we refer to as the rent tax. And according to the Ghana laws, it must be paid within 30 days after the rent income is received. And in Ghana too, we have two forms of this rent income. We have for residential premises, the rent tax is 8%, and for non-residential premises, we have 15%. So for residential premises, we have 8%, and for non-residential premises, we have 15%. So that is the tax rate. Let's take notice. Now let us look at some merits of direct taxes. Direct taxes have the advantage of creating income equity, and this is done through the progressive tax system, where we said that the rich pays proportionately more of their income as tax than the lower income earners. Direct taxes are certain. Okay, this means that you know how much to pay and when and where to pay and all that. So let's take, for example, the company tax. Let's take, for example, the company tax. You know, in Ghana, the general rate is 25%. So if in a year or in a particular period, you earn 10,000 as profit after deducting all other allowable expenses, you have 10,000 as profit. We know that the company tax is 25% times 10,000. It is certain. So you're going to get 2,500. It is certain. And then, so you know how much to pay. And then you know where to pay it. We pay it at Ghana Revenue Authority. You follow through the processes and then you pay it. So direct taxes are certain. Then we have the incidence of a direct tax is easier to determine. The incidence of direct tax is easier to determine. This is because the one earning the income pays the tax. So the incidence is borne by the person earning that income. So if it's an employment income, it's the employee that is bearing the tax. That is the incidence of the tax is borne directly by the employee. Then we have the cost of collection is comparatively low, especially much of the tax is deducted as source. Okay, so let's take the employee income, for example. We'll look at this more into details in Unit 3. With the employee income, I know most of us may be employed or have been employed one way or the other. The salary you get is not the gross amount, it's usually the net amount. So it means that the tax has already been computed and deducted from the gross amount, and then you are remitted the net. Okay. And another merit is direct taxes enables the state to reach a wider tax bracket. So here it enables the state to reach those nationals who derive their income from the home country but live for a large part of the year in another country. Let us look at some demerits of direct taxes. So direct taxes reduces disposable income. the high income tax can be a disincentive to effort and enterprise, especially in the case of overtime payment. In Ghana, overtime payments are taxed, and we'll look at this computation in Unit 3. Evasion of direct taxes tend to be easy because collusion between taxpayers and tax collectors. So it's very easy to evade tax. Evasion is an illegal way of reducing your tax liability. So you plan with the tax collector, pay a certain percentage lower than what you are supposed to pay. Then we have assessment of direct taxes is difficult in part to lack of records on income and profits of self-employed. Most of the sole proprietors or the self-employed individuals do not keep proper records of accounts. So it makes the computation of the taxes on their income very difficult. Now let us look at indirect taxes. Indirect taxes. So these are taxes imposed on expenditure on goods and services and are paid only when such goods and services are bought or consumed. So until you buy or render such services or goods, you are not going to pay tax. You are not going to pay tax. So indirect taxes are collected by customs, excise and preventing service, and value added tax service. Let us look at the main indirect taxes we have. So we have the value added tax, which we call VAT for short. So VAT is the tax applied on the value added to goods and services at each stage of the production and distribution chain. Please, the stress here is the value added. The stress is on the value added. So if you have the cost, and then so let's say you buy raw materials, for example, you are into sobolo business, you buy sugar at 10 Ghana cedis, okay, and you transfer the sugar together with other ingredients to sobolo and you sell it at 20 cedis. The value added is 10 cedis. So the taxation will just be on the 10 cedis, not on this whole amount. So I'm taking the definition again. It is the tax applied on the value added to goods and services at each stage in the production and distribution chain. Also, value added tax is treated comprehensively in the last unit of this model. The value added tax, it forms part of the final price the consumer pays for. And with the passage of the Value Added Tax Amendment Number 2 Act 2022 Act 108 by the Parliament, the VAT rate has been increased from 12.5% to 15%. So let's take note. The value added tax rate is now 15%. Then we have import duty. Import duty is a tax imposed on imports or goods brought into the country. The amount of tax to be paid depends on the value or volume of the items imported. Then we have export duty. It is tax imposed on goods leaving one's country for another country. So let's know that import and export duties are collectively called custom duties. Let us look at some merits of indirect taxes. They are relatively easy to collect since taxes are usually paid at the point of consumption. Okay, at the point of consumption. So for example, those retailers that charge VAT, you see on their receipt, you see the VAT amount and all that, which gives you the total amount you are paying for. So it's only at the point of consumption. If you don't purchase that product or if you don't engage yourself in that services, you are not going to pay the tax. Then the tax payer does not feel the burden so heavily when it is spread on many purchases throughout the year. Okay, you don't feel the impact directly because it is part of the price you pay for. So let's say you go and buy um, you go and buy goods from a retailer who charges VAT. When you look at the VAT receipt, you see the actual amount of the product and then the VAT and the NHIL and all other things as part of the prices. So the impact or the burden is not really felt. The taxpayer does not feel the burden so heavily when it is spread on many purchases throughout the year. Let us look at more ex- so let us look at some merits of direct indirect taxes. Some merits of indirect taxes. They are relatively easily to collect.